So now here's the first tweet for tonight. It says, here's an explainer on what's going on with the Silicon Valley Bank. In 2021, SVB saw a mass influx in deposits, which jumped from $61.76 billion at the end of 2019 to $189.20 billion at the end of 2021. Okay, so like they're only asking for $2.5 billion because of a bad deal. It's not bad. As deposits grew, SVB could not grow their loan book fast enough to generate the yield they wanted to see on its capital. As a result, they purchased large amount, over $80 billion, in mortgage-backed securities with these deposits for their hold-to-maturity portfolio. 97% of these mortgage-backed securities were 10-plus year duration with a weighted average yield of 1.56%. $80 billion. The issue is that as the Fed raised interest rates in 2022, and it's continued to do so through 2023, the value of SVB's MBS plummeted. This is because investors can now purchase long duration, risk-free bonds from the Fed at a 2.5 times higher yield. Now, this is something that we saw last night, but see how it was in a different space? We were talking about this last night. Risk-free, why aren't you buying a bond from the Fed? And this is at 2.5, so they're at like 4%. Well, it doesn't make any sense to use other debt instruments. That's the real problem with the Fed continuing to raise rates. As they raise rates, these yields will become even more attractive. Treasuries will become even more attractive, which will discourage investment in other things, in theory. This is not a liquidity issue as long as SVB maintains their deposits, since these securities will pay out more than they cost eventually. Yes, and that's the deal. With them, with the run on the bank, that's not good. That means they don't have the deposits as they used to. However, yesterday afternoon, SVB announced that they had sold $21 billion of their available for sale securities at a $1.8 billion loss and were raising another $2.25 billion in equity and debt. This came as a surprise to investors who were under the impression that SVB had enough liquidity to avoid selling their AFS portfolio. So what I would say is, like, let's say you're Peter Thiel. Congratulations to you for like paying attention. I mean, I cannot, even with my situation, I cannot imagine being that aware of a bank doing some things, and having it that, where I know what's going on. I mean, I just wouldn't. I'd be the last to know if something was wrong with the credit union that I'm at. It's sad, but I also, you know what? You know how you have the FDIC? I don't even have close to the FDIC limit, so I would be reimbursed eventually. But these companies probably have millions of dollars. Well, maybe even, I don't think billions, but maybe hundreds of millions combined. Anyway, okay. So this is CH on Twitter. It says, has anyone ever seen any real data-based challenges to the National Association of Realtors' assertion that the U.S. is short 5+ million housing units? Curious. It says demographic Chris Hazard had it at 1.7 million. Once upon a time, there was a shortage of tulips, tech stocks, subprime housing. Each was the result of financial conditions and a mania. Regarding real estate, I see no support for any other outcome, at least thus far, but I'll keep looking. So what he's saying is look, how do we know that there's this much of a shortage in housing? Does the National Association of Realtors have an incentive to produce data that is unfairly positive, weighted positively towards, the real estate business? Well, they do have an incentive. Okay. Now, is it a great enough incentive to perhaps ruin your credibility? I don't know. I couldn't tell you that. I just remember, and I'm just going back on history of what I saw with my own eyes. In 2007, it seemed like everybody I knew had like 4 houses. They had one house that they lived in. They had another house that they were fixing up, that it was in the early stages of fixing up. They had another house that was in the stages of close to being finished, but they were out of money. And then there was another house that they actually had rented. Like, it just seemed like everybody had 4 houses. And so when the market shifted, these people wanted to sell. They wanted out. Some of them were in it so bad they couldn't get out. If they were selling at a significant loss. But, if everybody had 4 houses and all of a sudden now those 3 houses go out back on the marketplace, that solves the shortage pretty quickly. Now, demographically, we have to say that the United States is certainly expanding its population by many different means, legal and illegal immigration. that is going to have an effect, obviously. I think the birth rate is declining. I can't prove that. I'm sorry. I don't have the numbers in front of me to back that up, but I think that the birth rate is declining. So it's all immigration related. So I don't know. It's going to be interesting to find out, if there is what I would call shadow inventory out there, and it becomes available. Shadow inventory in this case is not necessarily bank owned properties, but just property that's not being utilized to its residential real estate, not being used to its fullest extent of a single family homeowner residing in it. If that's the case, there is a significant amount of shadow inventory. Values will go down much faster, providing that those people don't have great rates on their mortgage anyway. If you're at 3% and things go down, might ride it out. Maybe. Just depends on your own situation. I thought this was fun. Now, this is where it gets really interesting to me. So Keith Raboy, he's involved with Open Door, which is a stupid iBuying program that it's terrible. But anyway, and you say, well, that's because they're getting rid of agents. No, the model itself is silly. Anyway, Silicon Valley Bank also deserves credit for Open Door. Without their supporters in the beginning, it would have been nearly impossible to prove we could value homes successfully via a model narrator. It turns out they could not value homes successfully, and that's absolutely true. They really did some vicious things in the marketplace. And then he's got the chart backdrop here of what's going on. Now, it's important to note that the SVB is not at zero. They could pull through. And I don't wish, that, these people lose their jobs or anything like that, or people lose their built up wealth. But things don't look good. Peter Schiff says the U.S. economy may be on the verge of another financial crisis. If so, the Fed may return to quantitative easing by the end of this month. This should send the dollar tanking and commodities soaring, especially gold. This could turn the financial crisis into a U.S. dollar and sovereign debt crisis. Now, there's always been this idea of the pivot or the soft landing. Those are the two trends that you hear out of Wall Street. The Fed knows what they're doing and that everything's going to be fine. This is an illusion. They've got a tough choice. They either, they can't even rein in spending in Congress. So they really have no tools. This thing could all just eat it. Now, what would that look like? I feel like, as I told you last night, I think that the federal government this is a bunch of liars. These are not good people. They will just paper over the problem. They will fix it, and they will help their cronies, the ones they can. The rest of us will just eat it. And we will, there'll be all kinds of stories about how it's cool to be poor, and that these people in the Senate are wonderful people, but I mean, my gosh, how many times are you going to paper over a problem you didn't fix in 2008? What makes you think you're going to fix it now? I don't have high hopes for that. Should there be a financial crisis, I do not have high hopes that the government will be able to fix it. Well, they'll be able to paper over it, but not. The systemic problem is spending is way out of hand relative to economic growth. And it was spurred by the Fed. I thought this was good. So this is Tracy Reinick. I don't really like her stuff that she tweets, but I read it. Here, I'll even put a like there. We're not on the same page. Anyway, it says today's softened stocks is really the fear of the unknown. Distress now appearing in the crypto space, as I predicted. Housing is not going to be the epicenter of the blowup. It was always going to be where the most speculation was. IPOs, SPACs, and crypto. And then Darth Powell comes in a year, housing continues to collapse at a historic pace, as I predicted. LOL. And then she writes back, housing is not collapsing. You can keep saying it all you want to, but it's just not true. In fact, one of the home builders saw a February sales rate of 7.2 per community. Normal level is 3.25. And what I would say to that is, when I go out, I will go out this entire weekend and show properties, okay, to buyers. And we will be in bidding wars with any property that we go try to buy. So we're going to have to go over ask. It's going to suck for the buyer. Even now, So while the data looks awful, there's still buyers. It's a wild situation. It's what I would call untenable, but we'll see. This is a guy that I don't follow, but I thought it was funny. It's Bucho Capital Guy. He says, rule number 1 in the crisis communications, don't tell people to stay calm. Rule number 2 of the crisis comms, don't tell people not to panic. I think that's funny. On the New York Post, it says Silicon Valley CEOs to investors, stay calm and don't panic. Like, those are the last 2 things you want to say. But what's funny to me is, like, I've always thought, see, I'm not very good at like crisis communications because I've always wanted to be like real and upfront with everyone. You know, like, hey, you know, if things are bad, I say, hey, things are not great. Like, we've got a problem here. Like, that would be good for me. I would accept it because, to me, you know, you shouldn't make stuff up. But if you create the perception based on what you say, a negative perception, it can have a devastating effect on the business as a whole. That's why when the Fed speaks, when Powell speaks, a number of times they've said he's just used the same script that he's used like for 3 years. He just changed like one word so he doesn't spook the markets. But who knows? Okay. Charlie Bilello. Median sale of U.S. home is down 1.2% over the past year. This is the largest largest year-over-year decline since 2012. Now look, it doesn't seem like a lot, 1.2%. The largest decline, though, since 2012. Everyone believes that the prices of houses always go up. And, you know, it's weird to me because let's just take an example. I'll even go to the main screen here. Let's just take one example, okay? Let's say you buy a house for $200,000, and that's a silly price now because you can't even buy a house for $200,000. But you buy this house for $200,000, and you sell it in 4 years, and you sell it for $210,000, and you put no money into it.